This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to your favorite podcast on all the nerdiest bank topics, Bank Nerd Corner. My name is Alex Johnson, and I am thrilled, delighted to be joined, as always, by my partner in crime in this endeavor, the banking and fintech editor at Bank Director, first among the nerds, Kiah Hazlitt. Kiah, how are you?
Hey, Alex. Good. How are you?
I am doing very well. Is it still 1,000 degrees where you are? It's incredibly hot?
Yeah. So I think we're in a heat wave, and then we had about 1 week of really nice weather, and then we're back in the heat wave. It is college soccer season, so I'm spending more time than normal outside. But actually, it just occurred to me that I think in a month, I will be seeing you IRL at Finovate. Fall,
that
right?
is so true. Yes. So for listeners, if any of you will be at Finovate Fall, you should make sure to swing by our session, because organizers of Finovate Fall have made the mistake of allowing me, Kiah Hazlitt, Jason Mikula, and Jason Henricks all to be on stage together for 25 minutes, where I really don't know what's going to happen. I know 25 minutes isn't enough time, but it's going to be amazing. So make sure that you do that. We may have some t-shirts with various Bank Nerd Corner slogans to give away at the show. So please try to find us if you'll be in New York that week. And in the meantime, we will try to sustain you with some bank nerd talk, including on some topics that we're very excited to get into. And Kiah, to do that, would you please introduce our special guest for this episode?
Yeah, I am thrilled to introduce Jim Bergin, a partner at Arnold Porter. Hi, Jim. Thanks so much for joining us today.
Oh, thanks for inviting me. I really appreciate it.
Well, we could not be happier to have you here for a number of reasons. We are going to talk about areas of expertise that you can help us cover in a little bit more depth. So we're going to get into Supreme Court decisions that have been made over the last few months that have impacts both obvious and subtle on the financial services industry. And we're also going to get into perhaps Kiah and I's favorite bank nerd topic.
Our newest favorite topic.
Our newest, yeah. I mean, we have a lot of children that we love at equal amounts, but maybe our actual secret favorite that we wouldn't tell the others is the Bank Service Company Act. You've heard us mention it before. We will be getting into that in a great deal of depth because Jim is the perfect guest to talk about it. But Jim, before we get there, as we were chatting before hitting record, you were mentioning that prior to joining private practice, you spent about 18 years working at the Federal Reserve. And just for folks listening, I think they would all be very interested in just getting a little peek behind the curtain of what that was like, particularly given that some of your formative years happened right around the same time as the 2008 financial crisis. So can you just give us a little bit of background on yourself and particularly your experiences working at the Fed?
Sure. Yeah, happy to. It was 18 years, so it's a lot to sort of like take in all at once. Yeah, I don't know. It's sort of, I have to think about, do I start with the dinosaurs and get all the way to present day, or do I just sort of do it at a headline level? So I joined Fed in 2005, and I was there till about 2023. And I have to say, I sort of didn't know what I was getting myself into when I joined in 2005. I didn't really know much about central banks, I would have to say. But I went there because I was interested in, public service, and I was interested in finance, and it seemed to be a nice intersection of the two. And so, I was there for a couple of years, just really liking it. Like working at a central bank is kind of like peeling an onion. Every time you think you understand it, there's some other aspect of it that pops up and you're like, wow, I didn't know central banks did that. And so that was all very interesting. And then, I kind of had I don't know if it's the word pleasure is the right word, but I was there in 2008 when everything kind of went hooey in financial markets. And so during that year, it was, as a formative experience, it's pretty good because I got to be a regulator, a lawyer, and work with the markets group. I had just a bunch of different roles and worked on all sorts of different things that were happening at the New York Fed at that time. And like the thing that's great about that is if you were bank reg nerds, as I understand that you are.
We are.
Going through a financial crisis kind of gives you like insight into lots of corners of bank regulation in ways that you may not have gotten before, right? So like 2005 to 2008, I was working on a lot of things that I probably didn't understand the importance of until, boom, here comes the crisis, right? So break W, why is there this wall between a bank and bank's funding and the rest of the holding company?
Yeah, what's the purpose of that?
Right.
Why is that important? Yeah.
Right. And so then you get it to 2008 and like, oh, okay, I get this now. All the holding companies were having funding problems. So like suddenly it became important. Capital. Why is capital important? Oh, I get that now. So it was kind of great in that way. So anyway, I'll pause.
The New York Fed is in the Fed network. It's like the market. Is it the market Fed? Is it like the... You know how all the Fed banks do their own little thing?
Yeah, what's the New York Fed?
What's
their little specialty?
So the New York Fed shtick is, they sit in New York. And so that...
That's such a New York answer to give. The shtick is they're New York.
Well, it's, historically the financial center.
Right.
Like I'm sure, as you know on this podcast, right, not everything that has been historic is sort of the same anymore, right? Like finances, things are sort of distributing. But like historically, New York as a financial center was like an important place for the Fed to be for certain reasons. And so the New York Fed shtick, roughly speaking, was markets, right? So implementer of monetary policy. So not necessarily the policymaker, but
not the FOMC.
Yeah. Although the president of New York Fed sits on the FOMC, it's, doing the stuff to make monetary policy a reality. That's kind of like the unique thing. Like a lot of the Feds have unique things. That's probably the most unique thing about the New York Fed. And then historically, supervised a lot of the large financial holding companies, and then other stuff like internet, cash, and things like that.
Got it. Okay, so that is perfect background. And obviously your experience and work as a lawyer is a really good segue for our first sort of set of topics that we want to ask you about, because as Kiah and I have made very clear on this podcast multiple times, neither one of us are lawyers. And so while we like to opine occasionally on the impact of various laws and regulations and Supreme Court rulings, it's always best to have a lawyer present while we do that. So Kiah, do you want to get into this next segment?
Yeah, so we actually talked about two of the cases that were argued before the Supreme Court this term, and that was Corner Post and Cantero. So Corner Post, briefly, for listeners who I assume are all up on our catalog, is the decision about how long a business has or a party has to bring forth a claim of injury. And the statute of limitations, is it when the statute went into effect, or is it when the business formed? And that would be, they have the statute of limitations from their formation to bring their case. And then Cantero versus Bank of America, that's the one we talked about, federal preemption. And, federal preemption is its own, should be its own topic, frankly. But it was, one of these decisions where we had the OCC was trying to figure out, and an OCC regulated bank was trying to figure out, do they have to follow a state law if they are under the national charter? And if they do, how do we just kind of understand state laws versus national banking laws? So, I'm not a lawyer. I just was trying to describe those cases as I understood them to Alex. But since we have had all of the Supreme Court cases have been decided, I thought it would actually be pretty useful for us to talk about the implications of these cases from the banking industry perspective, as well as what it means for the non-bank financial services perspective, because it does impact maybe how regulators kind of have to do their job. So Alex, did you want to start with one of them?
Yeah, I think the one that has gotten probably the most attention, and ironically one that we haven't gotten a chance to talk about too much on this podcast, is Loper Bright versus Raimondo. And I guess just without giving any of it away, Jim, can you sort of walk us through what the court decided in that case and kind of the headline on why it matters?
Yeah, sure. I think this is one of those cases that was kind of a long time in the coming, right? So this is, again, the Bank Nerd podcast. So there's probably words I can say in this environment and people will...
Nerd out for sure.
So Chevron, was a legal case that kind of was important for administrative law standpoint. Administrative law, what is it? It's basically the body of law that sort of governs how agencies do their business, right? So Congress makes laws, Congress passes those laws, and then, what happens then when they go over to the agencies? That field of law is kind of administrative law. And Chevron was a key case for administrative lawyers. And essentially, what it did was establish a principle of deference for agencies. So the idea was, and this idea kind of grew up in the wake of the New Deal. New Deal happens, lots of, the federal government kind of explodes in size. You have a lot more administrative agencies staffed with experts. And there was kind of a shift in kind of the decades after the New Deal to give more deference to those agencies. So courts kind of took the point of view, okay, here's a statute, an agency's been charged with interpreting it and making rules about it. We're going to say that their rulemakings, we're going to entitle them like with a certain amount of deference. So It seems like they kind of did the right thing here. We're going to let them go with that. And I mean, that's, there's a more technical way of doing this. The Chevron had, multiple tests and, is the statute really ambiguous? And, then is the agency acting sort of reasonably to fill in the gaps in that?
But the basic idea was that, like, if they're the experts, and so if there are questions, we should defer to them absent other justifications.
Yeah. That's kind of like a nice layman's way to put it.
And all of the bank regulators would have like assumed a Chevron deference when they make laws or rules. Rules.
When they make rules. Yeah. So, the way to think about it from an administrative law standpoint, right, is there are laws and there are regulations, right? What a regulation does is it makes, American individuals, American corporations subject to, it's something you have to follow.
Yeah.
It's kind of a big deal, right? So the agencies have to go through a process to issue regulations because those are going to be binding on companies and individuals. And so there's a process by which they do it. And, the courts would say, okay, if you follow your process and it seems basically reasonable, that we're going to entitle you to some deference. And so banking regulators, yes, in doing that, issue you have a statute, look for some authority, you have your authority, then you issue a regulation pursuant to that. But it's not just bank regulators either, obviously.
Mm-hmm. It feels like this decision connects to the SEC versus Jarkissi case, right? Because they both involve administrative agencies and then it kind of the determination of how do these agencies enforce rules. Or am I drawing a connection that's maybe not there between Jarkissi and Loper Bright?
Yeah, there's definitely stuff there. Can I finish on Loper Bright?
Oh, I'm so sorry. Yeah,
please do. Yeah.
I feel like I didn't finish the job, so let me just...
No, yeah.
Job. So I sort of set the table. Here's Chevron, here's the agencies in the statutes. What did Loper Bright do? It was a long way in coming because people kind of saw that the courts were increasingly skeptical of the Chevron doctrine. And what Loper Bright basically did is sort of took it to its logical conclusion, this skepticism, and basically overruled Chevron and said courts are going to interpret statutes and they're not going to just defer to the agencies. And the case says, it's job of courts to interpret statutes. There can be a single best meaning of a statute, and that's what judges do, is they interpret the single best meaning of a statute. That's sort of like at a high level what it does. It still preserves some things about the administrative state. So it says things such as if the agency experts produce good facts and it's useful, the courts will take account of those facts. That's one big thing. And another big thing is if Congress has made a specific delegation in the statute, the agency is like, hey, you do this, then that's still preserved. So anyway, I'll pause now.
No, that makes sense. So just a follow-up question on that then. So with kind of the broad Chevron deference ending, what do you think the impact of that will be for I think both banks and non-banks, because one of the things I've observed just kind of, especially recently, it seems like, is there has been a certain amount of, I'm not going to say like regulatory overreach, but like regulators taking a pretty broad approach to tackling certain topics. In some cases, to your point about like producing facts, maybe being a little light on facts or a little light on sort of the analysis going behind their rules. And so even when they're sort of following typical administrative processes for producing new regulations, I think there have been some critiques from industry on either the breadth of those rules or the sort of work that went into forming them. It sounds like with this, those will be potentially easier to challenge if you're industry and you want to have the courts actually decide if regulators are sort of overstepping. Is that a fair way to think about it?
Yeah, I think that's fair. I'm not sure I would adhere to everything you said there in that question, but I think it's fair to say, it opens up new avenues of challenge. You've sort of brought the courts have sort of reasserted themselves in a way. Like, so instead of, we need to figure out first if this statute's ambiguous, and then, whether the agency acted in a way that was not arbitrary and capricious, the courts are now a player on this field. So what does that mean? That's a big question. And that's, I've been talking to lots of people about that, and people have a lot of different opinions about what it means. And it will probably depend a lot on what statute you're talking about. Does it provide for some delegation? And, a range of factors. But yeah, it's at least a vibes changer, I would say.
It's a vibe shift for sure.
In that, like, will it change everything? I don't know. I kind of don't think it will. At the same time, the courts are now on the field in a way that they weren't before. And maybe that will lead to some different results. And we can talk about that if you want. I could go on, but like at some point I have to stop myself.
Well, did you want to bring up the connection between Loper-Bright and Jharkhasi, which is administrative courts, and, speaking specifically about the courts that bank regulators use in enforcement actions?
Yeah. So Jharkhasi, and I keep telling myself to pronounce it correctly, and then I forget which is the right way to pronounce it.
I'm pretty sure it's Jharkhasi.
Okay, good.
Yeah.
So that was basically the case, right? That SEC had a practice of bringing certain things before ALJs, administrative law judges. And this is another case that was kind of like a long time in coming. So if you were an administrative lawyer out there, you kind of had a feeling that this was not going to stand the test of time. So what happened there, basically the Supreme Court held that, an individual defendant has a right to a jury trial when the SEC seeks civil monetary penalties against them in a securities fraud case. And in making that analysis, what the court did was they sort of analogized the importance for thing, so I'll get there in a minute. They analogized securities fraud to kind of like a common law fraud. So it's sort of something that was available at common law. And so that, the basic analysis was, well, if there's something that was available at common law, that should be Article 3 court worthy. Article 3 court being like, judges and stuff, like not just administrative law judges. So, kind of put an end to what the SEC had been doing there.
I think the big focus of this case obviously was on how the SEC uses administrative law judges.
Yeah.
But thinking about, one, it's been underlined to me, and I think we discussed this with Todd Phillips, that enforcement actions are like legal documents. Like it's a lawsuit. It's not like just like a bad performance review without the force of law behind it. And there's always, in the opening of those actions, the claims, the laws that have been violated, right? Or the rules that have been violated that lead to the findings. And then there's, the language like the bank, neither admits or denies, the findings, but agrees to the following conditions. And then you have the enforcement action, or you might have a fine with that. And so my question is, like, does the Jharkhasi decision have any impact to the legal mechanics by which regulators use to bring consent orders and enforcement actions? And, is it possible that we might see more antagonism from banks, more, or do we think that the supervisory relationship between banks and regulators is such that they'll just pretend like the Jarkissi decision didn't happen when it comes to kind of the enforcement action.
Yeah, it's interesting because I was listening to the Bank Nerd podcast over the weekend, and I determined this was a place for me because podcasts, you get really into, whoa, how do banks interact with their supervisors and what does that mean? And, there's frankly not a ton of podcasts that are that excited about that topic. So good for you. So one way to think about it, whether it's a game changer or not, is you can kind of like hear who are the parties that may take a different attitude to an enforcement action now than before. So banks, so a supervised institution, so some entity that is subject to the authority of a bank regulator. A lot comes with being subject to the authority of a bank regulator. You have people coming in and supervising you. You have to keep up capital levels. You can have restrictions on your ability to expand based on, what your condition is. So it usually leads to not much less dispute in terms of enforcement actions, right? So if you're...
Yeah, I would agree with that.
Yeah. So you're an institution and your supervisor comes to you and says, we have grave concerns about, name your safety and soundness issue. And we'd like to fix those concerns. And you know what? We so much want you to fix those concerns. Here's an enforcement action.
Mm-hmm.
Usually you're not going to I'm going to court on that one.
Mm-hmm.
Just a lot of reasons for that. So that's one category. Another category could be like an individual that's associated with an institution. So like in bank regulatory talk, that kind of person is called an institution affiliated party. So somebody that's associated with a regulated institution, and there are enforcement authorities that bank regulators can use against those types of folks. That could lead to more disputes right there.
Right.
You have different incentives.
Sure.
You could be like, you could ban them from the banking industry. You could make them pay money. It affects their reputation in a certain way. So you'll probably see it come up there.
Okay.
And then, I see you have Fintech behind you, right? So what might be interesting too is for those companies who are affiliated with banks, if they become an institution affiliated party, the bank regulators come after them. That could also be an area where you could see some dispute.
Oh my God, I don't think we could have a better transition than this.
I was just going to say, that is the best possible transition ever to the main event, if I could be so bold as to say. I mean, so as I teased at the beginning of this episode, Kiah and I are like obsessed with the Bank Service Company Act, which is this very strange old law. And Jim, you and a co-author wrote a great paper called The Curious Late Life of an Old Law. And so I was hoping that we could just kind of dive into all things BSCA. And, if we could start just very, very simply, let's start here. What is the BSCA and who is subject to it, and what are the kind of main requirements of it? Can you just give us the overview and then we'll dive into all the nerdy details?
And this is a law, right? It's
a law.
Okay.
Yes.
So it's a law from Congress.
Law.
So let's start there.
Yes.
Yeah. And I have to say, I was listening to a bunch of your podcasts over the weekend, and I had no idea, honestly, there was so much interest in the BSCA. I was gobsmacked to learn that it had become the subject of.
It's mostly between three people who are trying to talk about it enough that people assume more people are talking about it, right? I think that's how we make fetch happen, right?
Exactly. We're trying to do a vibe shift on the BSCA.
It's like it's a hipster statute is what you're
totally
telling.
Probably haven't heard of it.
Yeah, you probably don't know. It's my favorite band, though. It's not a big deal.
So, all right. So how did I acquire my hipster interest in the BSCA? As I started out at the beginning, I did about the most non-hipster thing possible, and I worked at a central bank for a good period of time. And, one of our jobs there was to supervise banks and bank holding companies. And, there's a lot that goes into supervising a bank and bank holding company. Once you're within the bank regulatory perimeter, the supervisors have lots of tools to apply to make sure that you are safe and sound, right? I talked a bit about what they were before. But every now and then, right, you'd come upon some situation, right, where there would be an entity that was just a little bit outside the regulatory perimeter. And that's where you would perhaps look to the Bank Service Company Act. So there's kind of maybe one way to say this, right? There's sort of a regulatory way to think about this and a statutory way to think about this, or a supervisory way to think about this and a statutory way to think about this. So banks work with third parties a lot, right? It's kind of ineffable. It's just part of what it means to be a bank these days, but also it's been in the past, right? And you really can't run a bank without relying on third parties for some things, right? So, as much, somebody's got to pave your parking lot.
Yep.
Somebody's got to bring you paper. And, there's more complicated things, right? Somebody's got to provide you some kind of digital service that is hard for you as a bank to do yourself. And so when you're thinking about things as a bank regulator, what you want to know is this institution safe and sound? And from a bank regulatory standpoint, it's not a good answer if, you ask the bank, hey, I saw that you contracted with this digital service provider, whatever it is. Tell me about that. Tell me your operational controls. Tell me whether you have consumer compliance, risk assessments done with respect to that. It's not a good answer to say, well, we hired somebody for that and they're very reputable and it should be fine. So there's a whole supervisory set of principles and guidance that is built around that. What I just said is not the right answer. Bank supervisors have expectations for banks in terms of how they manage their relationships. And there's many, many pages of what those expectations are. They got reissued in a very exciting development in 2023. So there was supervisory guidance on that. So that's a supervisory way of thinking about it. There's a statutory way of thinking about it too, which is the bank supervisors have this power to take a look at those that are providing services to financial institutions. And it gives some examination authority, some regulation authority, maybe some enforcement authority for those entities. And where does that come from? It comes from the hipster law we were so interested in. And if you'd like, I can tell you what was happening when this law was invented.
I think one of the most interesting things about statutes is they are kind of grounded in this history that really speaks to what was going on and the concerns of what's going on. And then sometimes they are not always updated in ways that meaningfully reflect today's operating environment. And I think I understand why this law exists, and I think that it made sense at the time and it kind of makes sense now. But where I think one of the open questions is, what is a bank service company? And it's kind of grounded in the conversation of what was a bank service company in the 60s versus what is a bank service company today, and what does it mean to service a bank versus, what I think we've seen, which is banks using other companies to offer services to their customers. And so honestly, that feels like the most active part of the debate right now, would you say, is this definition not of the regulators and the examiners having the statutory power, but who receives examination because they are deemed to be a bank service company, right?
Yeah, so there's a lot there. So where did the statute come from? It sort of came about in the 1960s. Why did it come about? It came about because banks were having challenges developing the processing power that they needed to do their business, right? So, just think about the course of time, right? How big were computers at any decade, right? So when computers were first invented, how big were they? And now they're in my pocket. So in the 60s, how big were they? They were pretty big and they were expensive, and very similar to, the debates of today, right? It was easier for large banks, I think, to afford those things than it was for smaller banks, right? And so this led to a desire to allow banks to partner together to get those computers or get that processing power, get that service capability. And so the sort of the original thrust of the Bank Service Company Act was for banks to, form a company perhaps that would provide services to banks.
Yeah, it'd be like a bank-owned subsidiary that would own, where its only customers would be other banks.
Yeah.
So
Yeah.
it would be kind of within the umbrella of the bank holding company itself, right? Or all of these bank holding companies.
Yeah, exactly. So you could have like Bank A and Bank B and Bank C and Bank D, they would all get together and they'd form a company and they'd have interest in it. That was kind of like the idea in the legislation.
Mm-hmm.
I'm not sure that this is as much of a big thing now, but that was the idea. And, there were a bunch of different issues that if you look at the congressional record, you could see that the legislators were interested in with respect to this. But one of the issues that they were interested in, like relevant for our conversation, is that same thing about how it's not a good answer if you ask a bank, like, do you have good operational controls for X? And they can't point at the service company and say, well, but we've got this cool service company and they seem very reputable. Not a good answer then either. So that led to the inclusion in the statute of this sort of ability for the bank supervisors to sort of keep going, right? And go see the service company if they needed to. And if you want, I can talk you through the statute or read the part of the statute. It's very exciting.
Yeah, I think it'd be good to get into that a little bit, because the thing that Kiah was poking at and that I'm really curious about too is, the difference between the 1960s and today. As you said, it's a little harder to point to a ton of examples of these like bank service providers that are actually owned by banks. Obviously, we have some examples in the market today, but a large percentage, I would say the larger percentage of vendors and other service providers that banks work with, there's a contractual relationship, but there is no like ownership of the bank over the service company. So I would be very curious to dig into the actual statute and understand like where does that authority get limited by the statute, and how have regulators sort of worked around that over the years?
Yeah, I mean, there are some of those, but yes, I hear you. So yeah, the statute, just, sort of the part that maybe is the most important now is, I don't know. I mean, it's hard, too much to say.
How can you pick your favorite part? No, go ahead. Yeah.
Favorite part. Whenever a depository institution that's regularly examined by a federal banking agency, I'll use ... causes to be performed for itself by contract or otherwise, and services authorized under this act, whether on or off premises, such performance shall be subject to regulation and examination by such agency to the same extent as if such services were being performed by the depository institution itself on its own premises. And the DI.
I mean, okay, what does that mean today? Because that's, I think the distribution model of banking relies so much on third parties for so many aspects of banking. And it feels genuinely like, I think the whole question is, can regulators supervise some of these fintechs using this law? And it really comes down to kind of that definition of like services to and through, right? Like, and so you can kind of extrapolate who you assume is subject to the law today based on the roles they play within a bank and the services they provide to the bank versus how some of these banks use fintechs to offer services to their customers, right?
Yeah, so let's sort of get into it, right? So this language is pretty broad, but it's maybe not endless. So it says, causes to be performed for itself. So one thing, you might think about with some of these fintechs is that who's working for who, right? Is the fintech working for the bank? That's sort of like the old way of thinking about how a bank regulator might ask a bank about its service companies, like, tell me.
They're a vendor of yours. Yeah.
Is that happening? That's, maybe one thing to think about. By contract or otherwise, that's super broad. Any services authorized under this act, that's strangely broad. And that, and I won't really get into it here, but there's some interpretations of the Bank Holding Company Act to get sort of ported into that. That gets kind of broad. Whether on or off its premises, okay. And then you get subject to regulation and examination by the FDIC. So maybe the way to think about it I know the question you're asking, it may in some ways, maybe the mental frame to use it is, are you a service provider to a bank or is the bank a service provider to you? Maybe that's one way to think about it. Maybe that's just maybe more of a policy point of view.
Well, that did come up. That did come up recently, right, with the agency's RFI asking about bank fintech partnerships. They drew that distinction pretty clearly, more clearly than I think I've ever seen them publicly draw that distinction, where it's like, from an accountability perspective, are they buying something from you or are you buying something from them? And obviously, legally, they're still a service provider of yours, but contractually, practically speaking, sort of who holds the leverage in that relationship. So it does seem like the agencies are modernizing their thinking there a little bit relative to kind of the traditional interpretation of service providers.
And it's not to get too nerdy, but there's a political economy to this as well, right? So you think about, I think people usually have customarily thought, well, finance is a very big, important player and has a lot of bargaining power with respect to other parts of the economy. The rise of tech maybe changes that. So one of the things where this becomes important is, say, cloud service providers, right? So you've got huge cloud service providers. And, so just, again, nerding out a bit, from a political economy standpoint, who's got more bargaining power than the other?
Yeah, I think the Treasury is pretty concerned about that exact question.
Exactly, right. So they got into that and they've had public reports on this, right? And it's real, right? You could have a SIFI and maybe they have enough bargaining power to deal with one of the big cloud service providers, maybe.
Sure.
Or you could have, a bank in Indiana or Pennsylvania or Kentucky, and do they have the bargaining power to deal with a cloud service provider? It's much less clear. And, that's something I think the Treasury has noted, or the FSOC, I guess, in their report. And it seems like policymakers may be gravitating towards this hipster law of yours as one of the tools in the toolkit to sort of deal with that. And I should say, I'll get this, there is a supervision program for big IT providers today.
One of the questions that has come out of the BSCA is just, it's not one. So when banks are examined, we can guess who the examiner is based on their charter. But because non-bank service providers are outside of the regulatory purview, we don't really know who is subject to these exams. And you can guess, or some companies sometimes will disclose if they're public in their annual filings, but we don't have a lot of clarity around who receives this scrutiny from regulators. And we also don't have a lot of clarity around regulators' findings on the exams. And I don't know if that's just because they don't have a charter or because the bank service providers are A++ and there's no public exam feedback. And so I think that it creates this, it feels like a mystery power, but also it feels like, from my perception, that it's underutilized, and that as we've been looking at some of the issues that have come up that arise from these partnerships between banks and their service providers, it just feels like I'd like to see them experiment with the tool, with the law, so that we can have more a sense of the boundaries of this law versus saying gesturing to the law and be like, they could if they wanted to, but, I just assume that they haven't because of this service provider vendor relationship.
I don't know, right? I might think about it a little differently. So one way to think about this is, who is given this tool, right? This tool is given to the bank regulators. Mm-hmm. What are bank regulators interested in? Bank regulators are interested in the safety and soundness of banks and other institutions that are like banks, affiliated with banks, holding companies. That's sort of their mental starting block. How can I make sure that these banking organizations are going to be safe and sound. And so they've been given this tool, right? So that maybe their mental starting block is not, you have both fintech and bank behind you, right? But perhaps their mental starting block is not with the fintechs necessarily. And it's more like, what's going to be the effect on the banks? And you see this, right? There's just a lot of focus on service companies that third parties to banks.
Yeah.
The banks are doing it correctly. And, there's a whole nother ball of wax that I know you've talked about in multiple podcasts about whether banks and deposit arrangements are being conducted properly and what happens if a fintech blows up and, is it reflected in the record of the banks?
Right.
What I sort of I'm rambling now, but I might go back to okay, the BSCA is a tool that's been handed to the bank regulators, right?
Right.
So they're going to be starting with, how do we use this to keep these banks safe and sound? Rather, maybe the CFPB would look at it differently. They also have their own kind of third-party authority, which I know you know about. And so maybe they might look at it differently. I don't know.
Well, that's a really interesting point, actually, because I think as it kind of ties into all of this, and Jim didn't say synapse, just for the record, so we don't all have to drink because he didn't actually say the word. But, I do think that, to your point, one of the things I've been really curious about with Synapse blowing up and Evolve and just this greater focus on middleware platforms and banking as a service and these sort of new novel third-party arrangements is I have started to see a little bit of evidence from the FDIC, the OCC, the Fed, which, to your point, are really anchored on safety and soundness and systemic risk, asking a little bit more about consumer confusion, consumer harm. And so it is really interesting to watch how the sort of regulatory discussion based on what happens and actual harm that happens, how it gets dragged into sort of new-ish areas. And that was reflected a little bit in the RFI that the agencies put out, where they did ask about consumer confusion and applicability with consumer protection laws. And obviously, I think, as you mentioned in your paper, there is a lot of interagency cooperation, including with the CFPB around FFIEC and examinations of some of these service providers. And so the blending together of all of those is really interesting. The other thing, Jim, I wanted to ask you about before we stop all of our nerd talk on Bank Service Company Act stuff is I was curious for your take on how service companies might react to some of the stuff that's been happening here. Because one of the observations that Kiah and I have had and that we've talked about with some of our other bank nerd friends is because of what's happening in banking as a service and because compliance has now risen to the fore as a very important topic within fintech land, we've actually seen a number of these sort of banking as a service middleware platforms kind of reposition themselves to talk about them as service providers to banks. And so whereas before, say 5 years ago, they were very much nope, the fintech is our customer, the bank is our supplier, we're not a core provider, we're not regulated, we can move fast, we can be innovative. Now, given that everything is blown up, they're sort of switching positions in a lot of cases and saying, no, we're a service provider to the bank. We're just like a core provider. We provide a ledger. And in some cases, I've actually seen some of these providers sort of publicly bragging about the fact that they are being examined under regulators' authority under the BSCA. So it's like a point of pride or a point of distinction for these providers. I'm curious if you've seen any sort of shift in that direction or what you think kind of that means for the broader universe of service providers out there.
I mean, I think it's interesting. I don't know if I have a view on the direction. You could see, I can speculate about what their interest might be in doing that. I mean, clearly, it can be helpful to say that you're supervised sometimes. It can make people feel good. Or external parties may feel good that, somebody's looking at you and if you're especially, I mean, it depends on who you're talking about. There's insurgents and then there's not insurgents in the space. But
that's true.
It's sort of like a badge. Look, we're careful. Mm-hmm. It helps with risk allocation, but I'd really have to think about that, But I don't know. That's definitely an interesting point.
I think that the pivoting of the BaaS middlewares to cores is significant because arguably one of the clearest applications of the BSCA to a bank service provider is the core providers. And it's one of the safest to assume that those are being supervised. Yeah, I guess if we're transitioning, my 2 cents is that if regulators are gesturing so hard at the third party risk that third parties present to banks, it just seems like such a natural extension of, it seems like they are legit building a legal argument by which they can subject the companies that they see creating risk for the banks and saying, this is now, you're engaging in activities, you're presenting risks that do now threaten the safety and soundness of the financial institution.
Well, consumers not trusting the financial industry because they got screwed working with this fintech company, that's a safety and soundness risk. Absolutely.
So I will be interested to see if there's, the fortitude or the interest or the curiosity in we joke about FAFO, right? This is I'd like to see that from the regulators, right? I'd like to see them try. I just feel in our little hipster influence campaign, we're telling the FDIC that we believe you can do this. We believe in you. We believe in this law.
Yes.
And I certainly think they should do that instead of what they actually are doing right now when they think about the risk that, some of these deposit arrangements present to banks.
Well, can I say two things, maybe?
Yeah, please.
One is just I'm going to get at because the bank regulators, maybe I was overbroad. They do care about consumer protection too. Yes, and believe me, they will tell you if you think they don't care about consumer protection. Two, I think you've seen some policymakers talking more about third-party relationships, talking more about the Bank Service Company Act. So, one of the things I talk about in our paper is Governor Bowman of the Federal Reserve has brought it up, I think, at least.
Yeah, Bowman's speech is why we talked about it in Bank Nerd Corner.
There you go.
Yeah.
And, she kind of talked about it in terms of sort of leveling the playing field. Is it really fair to expect, the small bank from, I don't know, Louisiana to go up against the cloud service provider? Perhaps we have to use the Bank Service Company Act more. You've seen that. And I think Acting Comptroller Sue had a pretty...
He mentioned it too. Yeah.
It was pretty, I think 2 weeks ago, he had an interesting speech about, I think he called it the banking supply chain and how it's changing. And, so I think you see policymakers, Treasury, FSOC, obviously, you see policymakers grappling with this. I will say, perhaps change takes time, and change with bank regulators especially takes time, in part because it's a big system, a lot of dependencies. You have to be careful. If you do this, then that doesn't happen. So yeah, when I worked at the Fed, right, one thing people would say is it takes a long time to turn the wheel, but it's a really big wheel. So when you turn it even a little bit, it does a lot.
I think that's a very, very fair point. All right. So to wrap up the podcast, as listeners know, I always like to give Kiah an opportunity to blow off some steam and to rant about something that's bothering her. I think, Kiah, you don't get an opportunity sometimes in your day-to-day job to rant maybe as much as you might want with all the sort of journalistic requirements you're required to adhere to. We don't have those on this podcast. And given recent events, I feel 100% confident that I know the subject of your rant today. So all I need to do is mention one term, and then I'm just going to duck and just let you do your thing. Brokered deposits. Go off, Kiah Haslett.
Thank you, Alex. Thank you so much for this platform. I just want and I want to commend you on the nice addition of the music that you've inserted into this.
Thank you. Musical cue.
Two, I think it's really important to say that everything I'm about to say is my own opinion and not the opinion of my employer. And so the news, obviously, is that at the end of July, the FDIC announced that they were interested in reversing the 2020 update to the broker deposit definition. The FDIC, this is a law that the FDIC has to follow. It came from Congress in 1989 as part of FIREA. And so the FDIC has to designate deposits that come from a broker as a broker deposit. There's no definition of a broker deposit. There is a definition of a broker, and that is what is changing. The 2020 rule change was important to the fintech industry because before the rule change, many of the deposit taking relationships or the deposit arrangement relationships that banks had with fintechs would be classified as brokered, because if you think about it, the fintech is an intermediary between an end customer and the bank. And so it kind of like logically made sense that this was this
they were
fell
literally
under the
brokering
definition
it.
of a broker.
Yeah.
The issue, I think, is that brokered deposits carry a reputation. They have a reputation in the industry historically that has been that these are rate-seeking deposits back, especially when they were in the CD form, that they were easy to move around after the term expired. Banks had to use rate to bring them in. They were kind of easy to accumulate. You could just like attract them with a high rate. The deposits would come in. Because deposits are a debt for banks, they would then put these hot deposits into even hotter, higher yielding loans that were often speculative. And the FDIC has found historically that the presence of brokered CDs, I'm going to be specific, presence of brokered CDs specifically, can make failures more expensive and can make banks fail faster. So the relationship between the accumulation of deposits and the failure. Now, that's unclear if that happens for brokered fintech deposits. It is unclear how these deposits behave. The argument was in 2019 that these deposits behaved substantially differently than a brokered CD. So in 2019, the rule changes, and there's all these like other changes that go with it. So if like a deposit is put at a bank primarily to facilitate transactions rather than to be like a store of like money. And I want to highlight that because that's like the prepaid cards, right? Like these are for low and moderate income customers. They're often not trying to accumulate meaningful savings. They are just trying to use a prepaid card at point of sale.
Sure.
And so they would have to put some deposits at a bank, but really they're not trying to like save money. It's really to facilitate transactions. There was also exclusivity arrangements that were put in place. So if a fintech or another company just has like one bank that they put all the deposits at, those weren't considered brokered. But if the fintech had multiple deposits that they put banks at, if
that was
fintech
brokered.
Had multiple, those could be brokered. So now, do I think this is perfect? No. Do I think it mostly has to do with the fact that brokered deposit has to exist in some designation? And do I think that losing insight into the concentration of these deposits across the industry via the call report and them not being reported as brokered hurt the industry? Yes. Do I think that a mere update to the call report of third-party relationship deposits could have helped the industry understand, kind of the growth and the concentration at these banks? Yes. And I will actually assert that deposits that come into a bank indirectly may behave differently than deposits that come into a bank directly, because I believe deposits behave differently. Uninsured deposits, we learned, behave differently than insured deposits. That's probably something we need to think about, right? Or deposits behave differently in rising rate environments. That's probably something we all need to think about, right? That there isn't hot money and cold money. The nature of the money changes as the environment itself changes. And so it is stupid that the FDIC, sorry.
No,
FDIC.
rant, keep going.
It's genuinely so frustrating that in the year of our Lord 2024, the best tool, the best that the FDIC can give us to seriously think about the nature of these deposits and how should we think about safety and soundness when it comes to unsecured liabilities like demand deposits. The best they can do is reclassifying fintech deposits from non-brokered to brokered. And I kind of outside of the ideological, is this good for the industry long-term? It's not clear what data they used because the data wasn't included in the proposal.
Yeah.
They haven't meaningfully updated the 2011 study of core deposits that was mandated by the Dodd-Frank Act. And I don't know, does Congress have to tell the FDIC to update this study again? Can't the FDIC just update the study itself? Doesn't the FDIC have this data? If the FDIC doesn't have this data, how the heck are they making a rule that doesn't have data behind it? And I also am how do you not have the data? What are the examiners collecting during examinations that you don't have this data? And, Alex, I know you talked about this before because in 2021, Comptroller Sue also indicated that in a speech, it wasn't clear from the OCC's perspective how many banks were doing BAS, and he had to use the call report. And that seems so grossly insufficient that fix the data problem before you fix any rules that aren't working the way we wanted them to work, and genuinely be curious about deposits in general, rather than just reverting to the 1989 historical standard of brokered. Like, this is insane.
Okay, that was an amazing rant. I thought we might actually be able to get you to break your streak of not
just
really
one,
cursing.
Like, I'm really good at breathing and talking at the same time.
No, that was great. I mean, so first of all, Jim, you went into all of this with a sort of an ambivalent attitude about brokered deposits. Did Kiah convince you in any way with her rant? Do we need better data, do you think?
Yeah. Did I get you on that point? One point.
Listen, that is all very passionate, and that's good. It's good to have. I don't know if I have the same level of passion about the characterization of deposits that you do, but I don't know. I have to look at this a little closer.
No,
that's fair.
Again, very impressed by the enthusiasm.
Well, I knew this one in particular was a hot button for Kiah, and it is funny because, Kiah, I feel like your defining characteristic is, and it's probably like the journalist in you, you just want data. Like, just show me the data, show me the report, put the right stuff in the call report. Like, I need better data, which I agree with. And I mean,
shouldn't that be every single other person, though? Shouldn't the regulators also want the data?
I feel the same way, too.
Like,
no, well, and to your point, I do feel like they are, and they kind of hinted at this in their comments a little bit when they were announcing this rule, and there was people who were supporting it, people who weren't. It was a relatively close vote, I guess, as these things go. But they were hinting at, like, well, they'd talk about Voyager, they'd talk about Synapse and Evolve, and so they would sort of like give examples, which sort of made me think...
anecdotal. That's what we call it in journalism.
Well, yeah, they're anecdotal examples, and it sort of seemed like maybe they were working off of internal data or analysis that they had seen, but it's not available to the public, but we're not seeing any of this. And some of the analogies that they're drawing don't make a lot of sense. Like, there were a lot of problems with Synapse and Evolve. The way that the deposits were classified doesn't seem to have been a contributing factor to any of that. And so it's hard when they bring up these anecdotal examples that you're not really sure what the connection is to the brokered or not brokered designation, but they're like, oh, well, this is why I obviously have to vote for or against this thing. And so that was kind of weird. And the other thing, I think, to your point is it's just not, and this ties back to Bank Service Company Act too, it's probably not a good idea to get too wound up about what the original intent was when the law was written 30, 40, 50, 60 years ago, right? Like, the 1960s were a long time ago. Actually, Jim, in your paper, you did a great job of writing like a little intro for the paper that sort of made it sound like we were talking about today, but it was actually about the 1960s and the rise of check payments. Like, there are these patterns that are the same, but things also change. And, Kiah, to your point, I love the way you're talking about, like, it's not hot money, cold money. It's, weird money, not weird money. It's relationship money, not relationship money. Like, there's all of these different characteristics that relate to the way that the money comes in. And I'm very, sympathetic to the argument, I think, on certain fintech companies that are now going to have a harder time attracting bank partners because of this broker designation that's going to apply to their deposits, even though I think some of them would make the case, look, like, these are very sticky deposits. They're relationship driven. We only have, a single relationship with this provider. Like, they are stable in so many ways, but because of this on-off characterization that we have to have as brokered, non-brokered, we don't get to have that nuance. It's annoying. I want more nuance.
I mean, I will say that, BAS right now is, under some regulatory scrutiny. And I would encourage, if a bank genuinely believes that, like, follow the rule. So if the rule is report these as brokered, they are brokered deposits. If you genuinely believe in the strength of the relationship and that you're managing the risks of these deposits correctly, I don't really think the deposit classification should matter. It matters that the deposits might be more expensive. Sorry, you have to pay more to the deposit insurance fund. It matters that you might have to price the relationship differently to make up for the DIF assessments. But I understand that some deposits that are classified as brokered will not behave in a hot, flighty manner. They will just carry risks. And I do take the point that the FDIC wants banks to think a lot harder about the risks that these deposits carry. And if your analysis is that they are sticky or hot, that's an incomplete analysis. There's a lot of different ways that a deposit can carry risk, and that should change over time due to things like solvency, the interest rate environment, the relationship between you and the fintech. And so if you're not answering all of the questions and managing all of the risks, you're not doing your job. And I also think it's on banks, like, report the deposits correctly. Fill out the call report correctly. Because if you are lying on that call report, or if you are too stupid to know what's a broker deposit and what's not a broker deposit, then you have no business doing this. Like, this is kind of on banks for not following the rule correctly and for just assuming no deposits would be brokered. Like, they kind of set themselves up that 4 years after this rule change, we are already like, the FDIC is like, cut the crap. No more of this rule, right? You ruined it, kind of, right?
Yeah, no, that's fair. Because even before the rule just got, rolled back, the FDIC had specifically taken different banks to task for screwing up their call reports and classifying the deposits in the wrong way. So, even under the old rule, they were like, look, you're abusing how this works. So I am totally sympathetic to that argument.
Yeah. So, but genuinely, if you are a BAS bank and you want to be a BAS bank and you want to be a really good BAS bank, I don't actually think that the broker deposit designation should change anything in your bank. And if it does, then maybe you shouldn't be a BAS bank. And so that's kind of where I fall on this rule, which is like, everyone's kind of at fault and we're all kind of like dealing with these deeply imperfect understanding of deposits. And so I can't think about risky deposits as fully synonymous with brokered. We just know that deposits behave differently. And so we need to be really curious about that, and everyone needs to do a lot better. And also, FDIC needs its own data, and then the bank itself should have data that kind of supports all of its judgments around these deposits risks.
Yep.
So very deep thinking on deposits. It's great.
I'm a really big deposit nerd. Like, that is like my very weird subspecialty in banking is bank accounting and deposit.
That's one.
It's true. It's
really helpful when you're a technology reporter to have these two specialties.
Just like one thing, like just to bring it back to the second topic was like, Supreme Court cases, right?
Yeah.
So there are limits, right? So in terms of, but that was back in the 1960s, and now, well, I mean, kind of the impact of Loper Bright is the courts are looking for the single best reading of the statute. And, that's been part of the whole push and pull with the Supreme Court is, they're more into the texts and the original intention rather than sort of evolving standards. So anyway.
Right. Which is an interesting direction that we'll all be headed in. That is a great place to wrap it up. Jim, thank you so much for coming on the podcast and helping us bring a little bit more hipster energy to the BSCA and to some of these other topics. The Influence campaign is alive and well. We really appreciate your expertise. And for those of you who have not read the paper yet, and I assume there are a few of you listening, please do take the time to read it. It's extraordinarily well written. It does a great job getting into the history of the statute, how it's been used over time, and really invaluable stuff. So we appreciate your time and your expertise. Thanks for coming on.
Oh, it's my pleasure. Really fun. Thank you.
Thanks, Jim.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.